Good morning. We're here this morning to launch CBRE's Outlook document for 2014, looking at trends and expectations in each sector of the commercial property market for the year ahead. There's no denying that last year marked a major turning point, both for the Irish economy and the Irish property market. As NAMA, the banks and various borrowers and lenders brought and deleveraged loans and assets, sentiment in the Irish economy improved, and we noted a very significant increase in transactional activity in every single sector of the market, so much so that by the mid-year point, in most sectors we'd increased the volume of transactions compared to the previous year, and the year-end tallies were very strong in all sectors. We saw a significant increase in the number of international investors looking at investing in the Irish market. The recovery that we saw was evident in every single sector of the market, particularly at the prime end of the market. And coupled with the fact that we've had no speculative development in any sector of the market for a number of years now, we began to see supply shortages emerging in some prime locations, particularly and most notably in the Dublin office sector. That in turn led to some rental growth coming through in the office sector, and indeed prime office headline rents in Dublin increased by 25% during the 12-month period. The weight of capital from domestic and international buyers, coupled with rental growth coming through in some sectors, meant that there was a very sharp correction in yields in the Irish commercial market last year. Indeed, prime yields in some sectors came in by more than 100 basis points over the course of the 12-month period. Other significant developments in 2013 was the establishment of Ireland's first two REIT vehicles. Also, we saw the IPD index, which tracks the performance of the commercial property market, moving into positive territory for the first time in 6 years in the third quarter of the year. In the budget in October, the government extended the capital gains tax waiver for an additional 12-month period. All of these things very significant and helpful measures which will help to stimulate the market in the next number of years. 2013 was a very, very strong year, and it certainly looks like having been a stepping stone to the next phase of recovery and the next phase of growth in the Irish commercial real estate market. The office market in Dublin had a very strong year last year. Indeed, total take-up came in at over 170,000 square metres, which is up on the 10-year average in 184 individual leasing transactions happening in the market. Another very strong year is in prospect in 2014, considering the volume of foreign direct investment that we're continuing to see coming into this country, fuelled to a large extent by our 12.5% corporate tax rate, and equally with the Irish economy showing signs of improvement, indigenous company expansions will fuel growth. In addition to the uplift that we saw at the prime end of the market in 2013, we would expect to see some of that filtering down to secondary and provincial markets over the course of the next 12 months. 2014 will also be significant because we'll see the return of the crane to the Dublin landscape for the first time in many years, with some new office development taking part. Most of this development will be fuelled on the back of pre-letting activity, but equally we could see some speculative development coming on stream for the first time. This in turn will give rise to demand for development funding, whether it's from the Irish banks or from private equity providers. We'll also see an increase in the number of refurbishment and redevelopment projects, particularly in prime locations where supply is certainly a significant issue. The vacancy rate in the Dublin office market fell considerably over the course of the last 12 months. It started the year at over 21% and ended at 15.5%. So we would expect to see a further decrease in availability over the course of 2014, with the overall vacancy rate likely to end the year at about 13.5%. We will see further decreases in each of the various sub-markets, and the supply shortage of Grade A accommodation, particularly in the city centre region and in the south suburbs, will give rise to some further rental growth. In addition to the 25% uplift in office rents that we saw in the last 12 months, we're likely to see another 15% during the course of 2014, bringing prime headline office rents towards €40 per square foot. This in itself is significant because at these sort of rental values, development is potentially once again feasible. Over the last number of years, tenants have had the upper hand in lease negotiations, but with supply shortages becoming more evident, the balance of power is clearly going to move back towards landlords, with much more intense negotiations anticipated over things like lease lengths, break options and rent-free periods. A significant development during 2014 will be the adoption of the Strategic Development Zone, the SDZ, in Dublin Docklands, enabling development to start in this very strategic location in Dublin. The commercial lease database came into being over the last 12 months, and we would expect to see some improvements in this over the course of 2014, leading to much needed improvement in transparency in terms of office leasing transactions. So in summary, a very strong year anticipated in the office sector in Dublin in 2014. The retail sector of the Irish commercial property market has suffered more than any other sector over the last number of years, due in part to the slowdown in economic activity and consumer confidence. Retail sales have been quite volatile, even over recent months, particularly on a month-on-month basis, although it was encouraging to see the November figures showing an annual uplift in the volume of retail sales, demonstrating that there are clear signs of improvement beginning to emerge, with many retailers, depending on what sector of the retail they're in, showing an improvement in Christmas sales. We would expect to see the recovery that was experienced at the prime end of the retail sector filtering down to some secondary and provincial locations over the course of 2014, coupled with growth in the economy generally, with a decline expected in the high vacancy rates in many of the high street locations around the country. Much of the activity in the retail sector of the property market over the last couple of years has been dominated by the discount retailers. We would expect to see that changing somewhat over the next 12 months, with an increase in activity from a lot of high-profile and international brands who are looking for exposure to the Irish market, as we saw on streets like Grafton Street over the course of 2013. In addition to the expansion of some existing retailers, we can also expect to see some new entrants to the retail sector over the course of the next 12 months. We haven't seen rental growth in the retail sector for more than 6 years, but we could well see some rental growth emerging for prime high streets and prime shopping centres in 2014. It will, however, take some time for this to filter down to secondary and provincial locations. Some selective development will occur in the retail sector this year as well, although mainly comprising extensions to existing schemes, as opposed to speculative development. The speed of technological change is having a very significant impact on many sectors of the property market, but particularly the retail sector, as more and more retailing is being done online and consumer shopping patterns are changing. The need for intensive asset management has never been more critical in this sector. While there are some encouraging signs of an improvement coming through in some parts of retail, that's not to say that the entire retail sector is performing well, and indeed some retailers will have to change their business models and make difficult decisions. Indeed, it remains to be seen what impact the new examinership light legislation, which came in towards the end of last year, will have for this sector. We could well see some other retailers going down the examinership route in 2014. The industrial and logistics sector of the market is very specialist, and it had a very, very strong year in 2013, with almost 300,000 square metres of take-up being achieved, with the main players obviously being pharmaceutical companies, data centre and logistic operators. It is our belief that take-up will match, if not exceed, last year's record in 2014, particularly considering the demand from those three types of retailers. We're also expecting to see the first increase in industrial rents, particularly in the Dublin market, for the first time in 6 years in 2014, with rents likely to hit levels of about €6.30 by year-end 2014. At those sort of rental levels, speculative development doesn't add up, so we're unlikely to see any speculative development occurring in this sector. However, we are seeing increased demand for good serviced industrial sites, particularly those in close proximity to the M50, and we're seeing many occupiers paying premium prices for these sites in order to develop their own bespoke industrial facilities, a trend that we're seeing particularly in the data centre market. The technology and development in technological issues is having a very significant impact on the industrial sector. As more and more retailing is being done online, this in turn is driving demand for logistics facilities to service that. And the development of a national postcode system in Ireland over the next 2-year period will drive that demand. Many companies are trying to streamline processes and procedures, and that in turn will give rise to demand for new, modern industrial facilities, particularly those close to good road networks. The industrial sector in Ireland has never been a very dominant sector in the investment market. And indeed, in 2013, of the record investment activity achieved, there were only 5 industrial transactions of greater than 1 million in value in the investment sector, accounting for less than 1% of the total investment spend. However, as investors start to move up the risk curve into more secondary sectors in order to generate returns, the likelihood is that we're going to see increased investment in industrial, data centres and logistics sectors over the course of the next 12 months. We could well see some of the Irish institutions and the Irish REITs looking very seriously at investing in industrial and logistics properties over the next number of years. One of the most significant trends in the Irish commercial real estate market last year was the sheer increase in investment volumes, with a significant increase in the number of overseas investors and indeed Irish institutional demand for the commercial property and the loan sales that came to the market. In total, there were 96 investment transactions of greater than 1 million in value completed, totalling between them 1.78 billion. On top of that, there was another 750 million of Irish loan sales, bringing the total size of the market to 2.5 billion, a very significant increase in liquidity in a very short space of time. We expect to see an even higher volume of transactions completed in the Irish market in 2014. There is some concern at the pace of deleveraging and the extent of property that has to come to the market. So while it's important to feed the demand that's there from Irish and overseas buyers, at the same time it's extremely important that supply comes on stream on a controlled basis. Investors are encouraged by the extent to which values have fallen from peak. They're encouraged by the rental growth that's coming through in some sectors, and they're encouraged by the further potential for further yield compression, which is likely to come through over the next while. The pace of yield compression over 2012 and 2013 has been phenomenal. It's our expectation that the pace of yield compression will now ease somewhat, particularly as yields in most sectors are either at or close to their long-term averages. Over the last number of years, investors have played it safe and invested in dry, income-producing investments. We expect to see that changing somewhat, just as we're seeing in many other locations, where investors will move up the risk curve somewhat into more secondary assets in order to generate higher returns. We also expect to see an increased focus on non-traditional investment sectors, moving away from the office and retail sectors towards more non-traditional sectors such as student accommodation, healthcare, etc. We would also expect to see the multi-family residential sector becoming a mainstream investment class in Ireland. Indeed, it accounted for about 9% of all investment spend in the year just gone. With more and more overseas entities looking for opportunities in Ireland, we expect to see more partnerships and joint ventures from overseas buyers, who once were the competition but are now potential partners. With development likely to kickstart in some sectors of the market, such as the housing sector in Dublin, such as the office sector and the hotel sector, the re-emergence of forward funding is likely to emerge this year, with private equity firms likely to be the main suppliers of the funding. There's also going to be more competition between banks, with many international buyers bringing their own banking with them from outside of the jurisdiction, and huge appetite from non-Irish banks to get exposure to the Irish recovery story. We're also likely to see some further REIT vehicles emerging over 2014. The market isn't large enough to sustain a large volume, but we would expect to see some Irish entities converting to REIT status over the course of the next 12 months. And with more indirect investment in the Irish market, we would expect to see some of the existing REIT vehicles undertaking further rounds of fundraising over the course of 2014. Another sector where we saw an increase in transactions in 2013 was the development land market. If we count agricultural sales, we had a phenomenal increase in transaction volumes. Stripping them out and just focusing on non-agricultural sales, there were 75 transactions concluded in Ireland last year, totalling between them almost 200 million, up fourfold on the previous year. The demand for land is driven by improvements in the occupier markets, office, industrial and retail, and in the Dublin market, particular demand because of the supply-demand imbalance in the Dublin housing sector. Both of these fueling demand for good sites, to the extent that premium prices were achieved for many of the sites that came to market, particularly in the second half of 2013. As values slowly improve, development in many instances is becoming feasible again, and this in turn is driving the demand for land. We would expect to see further escalation in land prices, particularly in the Dublin market, over the course of 2014. There will be land sold provincially as well, although most of the buyers for this will comprise local buyers in the main. The extension of the capital gains tax waiver in the most recent budget for an additional 12 months is significant for many sectors of the market, but particularly the development land, with domestic buyers very encouraged, and undoubtedly this will be an important demand driver in 2014. We expect to see an increase in the volume of land coming to the market this year. In addition to a lot of the small infill sites that formed part of the market over the last number of years, there will also be an increase in large land parcels being brought to the market, sometimes coming to the market as part of mixed-use portfolios. Equally, we're likely to see some of the sites that form part of the loan portfolio sales over the last number of years being carved up, and these sites being offered for sale over the course of the next 12 months. As we move into the next cycle of development in the Irish market, there will be increasing pressure on existing banks to start providing development funding, which at the moment is being provided by a lot of the private equity players in the market. There's a lot of concern in the market about the potential for government to introduce a vacant site tax in 2014. An audit has recently been done by Dublin City Council, which has identified up to 60 sites which are vacant and not being used at the moment. However, there's likely to be a considerable backlash if government introduce such a levy, because penalising developers for not developing sites is not going to stimulate development where that development is neither merited nor feasible in the first place. In summary, a very strong activity level expected in the development land sector this year, with an increase in sites expected to come to the market, both within Dublin, provincial locations, and many places around the country. There was a notable increase in transaction volumes in the hotel and licensed market last year, considering that only 2 hotels in the entire country traded in 2009 and only 3 the subsequent year. There were 33 hotels traded in Ireland last year, totalling between them 159 million. And of particular interest is that 86% of the value of those transactions came from outside of the jurisdiction. 13 of the 33 hotels were purchased by non-Irish entities. Many of the hotels that were brought to the market last year came for sale towards the end of the year. With the result, there's likely to be a carryover of transactions from 2013 into the first quarter of 2014. Several high-profile Dublin city centre and indeed many well-known provincial hotels are going to come to the market over the course of 2014, and we would expect to see strong demand for these properties. The hotel and licence sector is another sector where the extension of the capital gains tax waiver in the recent budget has been helpful and will certainly stimulate demand. The demand for hotels is likely to continue to emanate from overseas purchasers in the main, and many of the entities who bought over the last number of years are likely to buy further hotels. We may well see some new entrants from jurisdictions that haven't yet invested in the Irish market in 2014. Just as development is beginning in some sectors of the market, we will see the first signs of new hotel development emerging in the Dublin market this year, with many of the hotel projects that went through the planning process over the last 12 months starting construction. There was a significant surge in the volume of pubs that were traded in 2013, with very strong demand for many of the properties that were brought to market. And this year we expect to see that trend continuing, with an increase in the number of trading Dublin pubs likely to come to market over the next number of months. We saw the entry of Wetherspoons and some other UK entities to the Irish pub market last year, and we could well see them buying again in 2014 and other UK entities coming into this sector. The hotel and licensed market obviously had a very strong year last year, buoyed by events such as the Gathering, with tourist numbers up 7%, close on 8 million visitors to our shores. It remains to be seen if that activity can be replicated again in 2014. However, with the extension of the 9% VAT rate in this sector, the abolishment of the air travel tax, and many new air routes due to open, the likelihood is that we're in for a very strong year again in the hotel sector in 2014. In summary, 2014 is certainly shaping up to be an even stronger year in the Irish commercial property market than the one we've just seen, with activity on the occupier and the investment side likely to improve even further over the course of the next 12 months. That's not to say there are still several legacy issues to be tackled. Our economy remains susceptible to macroeconomic developments, but an improvement in the domestic economy and some improvement in the provision of bank funding is encouraging. We expect deleveraging both in terms of asset sales and loan sales to continue at a similar pace to last year. It's extremely important that deleveraging continues on a controlled basis. With quite a lot of properties brought to the market towards the end of 2013, transactional activity will emerge much sooner due to the carryover from last year, and indeed Q1 take-up and spend in most sectors is expected to be quite strong. We're going to see the emergence of rental growth in sectors like retail and industrial, which haven't seen rental growth in over 6 years over the course of the next 12 months. We're also going to see a continuation of rental growth in the office sector in Dublin, with the prime office rent likely to hit €40 per square foot by year end. Ultimately, this improvement will filter down to secondary and provincial markets. The pace of yield compression that we've seen over the last couple of years is expected to ease somewhat. With yields at or close to their long-term averages, it's extremely important that Ireland remains competitive. We expect to see continued appetite from international investors to get exposure to the Irish recovery story, both in terms of the economy and its property market. We are likely to see further indirect investment in the Irish real estate sector, and we're likely to see the emergence of some new Irish REIT vehicles in 2014. The year will be significant in the sense that development activity will commence once again, particularly in the office sector in Dublin, in the Dublin housing market, and to a smaller degree in the hotel sector. This development, however, will be on a small scale and from a very low base, and will not kick off to any significant degree until such time as rents justify development and until such time as funding is available to enable development to take place. Any of the development that starts in the office sector is likely to be on the back of pre-lettings as opposed to being speculative. While we're encouraged by the recovery that has come through in the Dublin market over the last 12 to 18 months, it will indeed be some time before the recovery becomes established outside of Dublin and other major cities. Technology and globalisation will shape how the next cycle of the Irish real estate market works. Technology and globalisation will influence how real estate is planned, designed, occupied, owned and managed.